Tēnā tātou, no mai e te tine e te rau, ko Mike Woodbury toko ingoa, he hoa rangapū ahu ki Chapman Tripp, ki te whanganui atara nei, e mihi kau atu ana, kia tātou katoa. Welcome everybody to the big themes and issues for workplace savings schemes. Before we begin, thank you as always to our sponsors. The ReGenerations conference, He Waka Eke Noa, is only made possible thanks to their generous support. So thank you everybody. I want to introduce our speakers today. Firstly, Sarah Graydon. Sarah is an experienced lawyer who's worked in a number of areas and predominantly in-house roles. She headed up the legal team at New Zealand Post for 8 years and now works with Juno Legal, providing advisory, coaching and legal services centred on in-house legal functions. Sarah's governance experience spans super, health and education. She's a licensed independent trustee and currently holds positions with 4 workplace schemes, including police and universities. And Gavin and I concur that Sarah roughly doubles the collective IQ of this panel, and we very much look forward to hearing her insights. Gavin Quigan likely needs no introduction to any of you here. I hope he's here. He's currently the FMA's Principal Advisor, Restricted MIS, but I prefer MVP. He's been helping guide our industry in various roles with the Government Actuary's Office, the Insurance and Superannuation Unit of the Company's Office /MB, and now the FMA for 36 years and counting. I'm Mike Woodbury. I'm a lawyer. I advise on retail, employer-sponsored, industry and faith-based KiwiSaver workplace savings and super schemes. And I've spent my entire working life sequestered here in this quiet room at Chapman Tripp in Wellington. I'm a former chairman of Workplace Savings New Zealand. I'm now on a range of FSC committees, and I'm a passionate, which of course means annoying, advocate for change in the better in the retirement savings industry. So let's go, David Bishop, who's driving our slide deck. I'll start with a session outline. So our session will be in broadly 3 parts, the third of which is the key one really. We start with the now customary update from Gavin on the size and shape of the sector. Then we'll allow some questions. Then we're doing an update on just recent and pending developments directly targeting or impacting restricted workplace savings schemes. And then again, some questions are most welcome. Lastly, some key learnings from other sector guidance and reforms, which are listed there. Really, what we're looking at there is how do these developments impact workplace savings schemes, and how might the learnings help trustees and managers better serve their members? But I'll turn now to Gavin for his update on the size and shape of the sector.
Thank you, Mike, and also to FSC and your sponsors for the opportunity to be part of this discussion panel. I thought I'd start with a little walk down memory lane. Back in 1994, I joined the Government Actuary's Office. And the first report to Parliament, which I was involved in with the Government Actuary, was the 30 June 1995 report. Back then, the superannuation landscape in New Zealand was very different. 1,584 retail and workplace savings schemes were registered with the Government Actuary. Of the 1,584, 1,447 were workplace savings schemes. 137 retail products were on the books, and of that 137, 80 of them were run by life officers. Assets under management were 14.2 billion, annual contributions of 2.5 billion. Membership of superannuation schemes back then was 672,000 people. 372 were retail thousand, and workplace savings had 300,000. And there were 42,000 pensioners receiving pensions. Moving forward to today's date, of course, as you'll see on the slide, the numbers are significantly less in terms of schemes and membership. However, of course, assets over the years have continued to grow as given the benefit entitlements of registered superannuation schemes, restricted schemes are much better than what you get if you're a member of KiwiSaver. So I think that just demonstrates the value of traditional employer-based superannuation schemes. When you see that we've now got over 26 billion in assets under management. What does fly below the radar a little is the number of employers that participate within the master trust superannuation scheme industry, and there's around 760 employers that have superannuation schemes under master trust products. So in summary, major reduction in schemes, members, pensioners participating in traditional superannuation schemes. And in part, I think that demonstrates the dominance in today's world of KiwiSaver and the success of KiwiSaver, in fact, as the go-forward provision of retirement savings for New Zealanders. And as an aside, there's 15,000 employers who have KiwiSaver preferred provider agreements in place with KiwiSaver providers. So, there's also been quite a large increase in the number of employers who are choosing a particular KiwiSaver scheme as a preferred provider for their staff. Moving on to slide 2, the restricted schemes world is pretty stable. Been a little bit of change in terms of assets and schemes and membership, and that's in part due to the medical assurance superannuation and KiwiSaver schemes transitioning to become full retail products and giving up their restricted scheme status earlier this year. So that was one restricted scheme less and one restricted defined contribution scheme less. But of course, their assets had an impact on that and membership. And also the BNZ OPA, all of the active members were transferred to the Mercer Super Trust during the last year. So that scheme now just has a pensioner rump remaining as a restricted scheme. So that's probably all I've got to say on slide 2. So slide 3, I just thought for a change I'd do a little analysis on just the workplace savings schemes, excluding all of the NPF and the 3 restricted master trust products that of which 2 are on market, 1 is closed. So 17 schemes with over 100 million in assets, and they've got 2,600 pensioners. It shows that overall for just the employer-sponsored schemes, excluding NPF, that there's not many pensioners left in traditional workplace savings schemes. Other industry, in terms of other things, other industry trends over the year. 3 relatively large employer schemes within master trusts have transferred between master trust providers, courtesy of FMA consent process. So there's a bit of movement in that space. 48 consents were granted to restricted schemes for amendments to trust deeds over the year. The amendments range from updates for the new Trusts Act requirements and also a couple of deed amendments to facilitate pensioner cash out options. So it's certainly a trend at the moment to see quite a lot of rationalisation within schemes. Recomplying super funds, which of course are the KiwiSaver equivalent lock-in benefits. There's 15 schemes within the that have compliant super fund status, 635 million of assets, based on latest annual reports, 13,184 members, and in the last year, authorised payments or KiwiSaver transfers worth 28.3 million were paid out. The largest compliant super fund is the UniSaver scheme, which accounts for 57% of that asset number and 52% of membership within the CSF facility within restricted schemes. In the lit space, currently have 32 individual and 3 corporate lits. It's been 12 months since the last new lit license was granted. And since the regime commenced, 7 lits have ceased to hold a license for various reasons. So, yeah, it's a shrinking space as well. Yeah, open to any questions.
Gavin, thank you. We don't have any questions at this juncture, but I'll keep an eye on the Q&A field.
Thank you.
Why don't we move on, David, to just the restricted schemes focused update. Firstly, the right sizing initiative work trundles along in relation to our right sizing compliance obligations for restricted schemes initiative. These are the suggestions for exemption relief to lessen restricted schemes compliance burdens in a range of areas. We made a submission mid-year on FMA's proposal for a restricted schemes class exemption. It would do each of 3 things: relieve DB schemes from having to produce fund updates due simply to some younger members not yet being entitled to defined benefits, and all members having voluntary contribution accounts and just thereby being exposed to investment risk. Secondly, removing the requirement to prepare and lodge usually nil quarterly reports to FMA on limit breaks and related party transactions, and replacing it just with event-driven and otherwise annual reporting. And lastly, expressly allowing DB schemes to provide annual member statements which are benefits-based rather than transaction-based. Another vexing issue we continue pushing is resolving the timing challenge caused by having to produce member statements within 3 months post-balance date, because in practical terms, this accelerates the financial reporting and auditing deadline for a non-unitised scheme from 4 to 3 months. Gavin, are you able to update us on where these and any other relevant issues are at currently?
Certainly, Mike. Regarding the right sizing exemption work, that's almost at a point now where PCO drafting for PCO has commenced, and we hope that will be with PCO before Christmas. So at this point in time, dependent on PCO's capacity, we're hopeful that by the end of Q1 2022, that exemption may well be in place. But yeah, very dependent on PCO's capacity at this point in time, and of course the Christmas break. With regards to confirmation information, as we all know, unfortunately, that particular change needs a legislative fix, and so is with MB. They're aware of it, but it's a matter of finding a legislative vehicle and timing for that to progress, unfortunately.
Thank you. So we'll move on to just a bit of a potpourri now, David. The next slide, other directly relevant developments. The restoration of a 33%, not 39% ESCT rate for employer contributions to DB schemes to fund pensions in payment is set out in the current taxation bill, but it's taking effect effective 1 April 2022. This week's FSC submission on the bill urges in very strong terms that the change be fully retroactive to 1 April 2021, given the relatively straightforward square-up mechanics and because the change will do no more than remedy additional tax that should never have been imposed. So watch this space. GST on managed funds. So the number of reform options in this area now seems boiled down to 2. These are that for certainty and consistency, the supply of manager and investment manager services, including in relation to retirement schemes, either becomes fully GST exempt or fully GSTable, with no shades of grey. Consultations occurring, and the chosen option will potentially be included in a 2022 tax bill. Officials are fairly concerned clearly about boundary and fiscal cost issues with any full exemption, and their latest consultation note indicates any exemption might not extend to admin services even if granted. So we may need to watch out for that in this sector, because delegated admin management is of course correctly regarded as management. IR seem to be intimating that making management fully GSTable, unsurprisingly, has a bit more to commend it from their perspective, including because it would reduce uncertainty as to whether a service fits within one category or another, and would remove the need to split out or apportion fees that are used to charge for multiple services. It seems likely that whatever happens, a significant transition period will apply, and that if the new rules came into effect from, say, 1 April 2023, there could be a 2 or 3 year grandparenting period for contracts agreed before then. FSC feedback is being sought, and I'll be joining a 25 November discussion with IR. Next point, FMA is consulting on levy increases to help fund its ever increasing remit, and happily those increases will be targeted to the affected retail market participants via revised and new levy classes. In other words, they'll be weighted towards the larger banks, insurers, and climate reporting entities. MB are proposing that Class 5 levies, which are those impacting restricted schemes, won't change, and that, for example, a restricted scheme worth between $100 and $250 million will continue paying an annual levy of $32,000. Even those modest levies, in my view, still have an element of cross-subsidising other aspects of FMA's activities, but at least it does appear that MB are holding the line. It remains the case that on paper, a single-purpose nominee company acting as a restricted schemes custodian must pay an annual levy of $11,900. I trust none of you are being asked to pay this levy currently, and be assured that its express disapplication is somewhere in the pipeline. Gavin mentioned 32 LITs now in the saddle and 3 corporate LITs. The 2016 LIT exemption notices were rolled over for another 5 years recently. The independent LITs exemption notice is the one that enables a LIT who is in substance independent not to fail the independence test due simply to being on the directorate of a corporate trustee, which is related to the sponsor, or in 1 or 2 cases, the admin or the investment manager. The corporate LITs exemption notice was also rolled over several days ago, and that clarifies that a trustee corporation can act as a LIT. As Gavin said, some ongoing attrition in this sector, obviously, as we all know. We've contacted FMA commending to them that with the ongoing attrition of schemes in this sector, they should be looking to put in place a class exemption facility, exempting a scheme which is in wind-up from the otherwise ongoing requirements for annual reports, annual audited financials, and in need fund updates while it completes the wind-up process. And this will give the scheme compliance relief where, for example, due to delays in liquidating assets, the completion of the wind-up process straddles more than one reporting period. And FMA have advised that they've got this on the list for 2022. We've got a question. FYI, the FSC is running a focus group together with the IR on their GST on managed funds review. Please do contact the FSC if you'd like to attend. Thanks, Carissa. Lastly, we had an interesting little nugget from FMA last week on self-reporting of issues. And those that have heard me over the years have heard me go on about this. In a published speech last week, the FMA reinforced yet again the importance of self-reporting incidents or issues to FMA when things go awry. Something that's of particular moment to restricted schemes, as you of course don't have any supervisor intermediation. In FMA's words, while entities may be tempted to wait until they've fully unravelled problems before first making contact with FMA or members, we urge you to prioritise early engagement and stopping the harm. Self-reporting can't provide immunity, but delayed or incomplete self-reporting is considered an aggravating factor. So by implication, timely and transparent disclosure to FMA, which of course means Gavin, remains a key mitigant. So David, we'll move on. For the remainder of this morning's session, I'm going to very briefly outline each of several new, more macro level developments, none of which is really targeted at restricted schemes, but each of which offers valuable learnings or points to watch out for. And then Sarah, as a lit, is going to offer some practical, real-world observations about how her various schemes are responding in each area. So I'll start with FMA's fees guidance. I'll just make sure there's no questions. No. In April this year, the FMA released a paper called Managed Fund Fees and Value for Money, a guidance note, setting out what it calls guidance and principles to help managers demonstrate how they are meeting their existing obligations, statutory duties, and conduct expectations in respect of fees and value for money. The guidance is directed at helping all scheme managers, and that of course includes restricted scheme trustees, to meet their overarching statutory obligations to act in members' best interests and treat members equitably. And FMA says those include acting in members' best interests from a value for money perspective. Restricted schemes are largely, of course, price takers, which operate on a cost recovery and not-for-profit basis. But the guidance is nonetheless relevant and helpful in several key respects, we feel. The key point is that trustees should continuously review their fees and their value for money, and there should be at least one formal annual review of whether the scheme is still providing value for money. If that's not the conclusion, the trustee board should agree on appropriate steps to increase the scheme's value to members or reduce its cost. And I personally see this expectation coming into fairly sharp focus, for example, with smaller, more vanilla DC schemes that are standalone and have relatively high fixed costs and which can practicably be migrated to master trusts on mirrored terms and conditions. The fees reviews reflect four key principles. I've listed them there. Firstly, risk and return are critical with investment management fees in particular. FMA say the two key indicators of value for money in that space are how well do the manager's processes and capabilities minimise investment risk and returns after fees. In other words, what is the proportion of investment gains taken by the manager as fees? And this necessitates, practically speaking, a comparative analysis against underlying funds with similar strategies. Secondly, the financial value of investment management must be shared. A member doesn't obtain the financial value of investment management if it isn't shared appropriately between the manager doing the work and the member paying the cost and taking the risk. Thirdly, a service or feature provided by a manager contributes to a member's value for money only if it's actually used or acted on with a positive impact, not merely offered. And lastly, boards should review themselves as they review others. So when evaluating your own lit and directors' fees and cost base in terms of their value for money to members. Here I'll turn to Gavin in the first instance and then Sarah for some commentary.
Thanks, Mike. I think I've made the point before that restricted schemes aren't explicitly named in the fee guide, and that's in part in relation to the fact that, as Mike says, your fee takers. I think the larger schemes can negotiate and do negotiate good discounts and get wholesale investment management fees, but when it comes to administration, you certainly have a lot more work that's required to be done on a daily basis than, for example, a KiwiSaver scheme, with benefit payments as members leave service, etc. So given there's only a couple of administration managers in the market, that doesn't make it easy in terms of pricing, from what I gather. So I think it's definitely good for you to review the fees on a regular basis, and whether or not you feel you're getting value for money from the performance of your managers. In respect of for example, say Master Trust products, which are not restricted but on market, it's my view that they should be very carefully looking at the value for money proposition that the various participating employers get from their schemes, and reviewing their fee structures for individual participating employers to ensure that there's equity across the book, and that some historical fee structures, which probably are way past the use by date, are in fact brought more into a user pays environment, as opposed to fees which are admin fees which are contribution based as a so yeah, certainly I think there's potentially work to be done in that space by managers of Master Trust products.
Thanks, Mike. Sarah.
Morning, everyone. I thought maybe before offering some thoughts, I might just give a quick outline of the different schemes I'm involved in, because I think I probably have both one of the smaller schemes in the country and one of the bigger ones. So I can offer a range of perspectives, as well as being involved with both open and closed schemes. So I started out in this area while I was still at New Zealand Post, and I remain involved with the New Zealand Post scheme, which has been closed for quite a while now. I am also the LIT for a small scheme based in the South Island. And then at the other end of the scale, I am the licensed independent trustee for the university scheme, and also on the board of the police scheme. So it'll be fair to say I've got a range of quite different perspectives, and each of those schemes has different approaches to how they manage the scheme, how they get advice, how they administer their members and assets and things like that. In terms of the value for money guidance, I found it a really useful set of questions to be going through, and what it is provided in terms of a principle-based way of reviewing something in totality. For the most part, happily, these things are always very much at the forefront of our minds, knowing that any additional cost or fee is going to be money that our members don't then get, given the way that these schemes are structured. So part of it has been almost a way of checking that what our existing work plans and our existing reviews and things that we already have in place are covering the right bases, and happily, for the most part, that was the case. But I think some of the interesting areas for me that this flagged up is how you compare yourself to other schemes, because that is a really useful way of knowing whether you're doing a good job of managing your costs and fees. And comparisons are not always straightforward. Finding like for like is pretty tricky, but I think one of the great things about this area is because we're not in competition with other workplace schemes, there's a great amount of information sharing that goes on, and people are willing to share between schemes what they're doing, what works, and that provides some useful comparisons. Also, we have looked to what Australia does and to comparable schemes over there to see what we can learn from that. One of the areas that this guidance did probably make us think more about in a couple of the schemes are, and that's value-added services space. When you're looking at enhancements to the scheme, that there are a couple of ones that we're considering at the moment, and actually really thinking, how will we know if this is going to be actually being used and adding value for our members? You know, there'll be additional cost. Is this just going to benefit some members, but all members pay for it? Or you know, how equitable is it in that respect? And also, maybe making us think a little bit more in a more structured way about some of the existing enhancements and how those are being taken up and what the tangible benefits are for our members, which can be perennially hard to judge, but that's not a reason to not engage and try and get a bit more of an idea around that area. So those are probably the main things that stood out from that guidance. I found it really helpful, and it's good to be able to draw things together in a way and actually do a sort of holistic review of this area. And whether it sort of is directly applicable to our schemes or not, some of the ones we'll be discussing later, so our schemes are not strictly speaking required to comply with them. The attitude is generally you should look to what the best practice is, regardless of whether we're strictly caught by having to comply with particular things, because we're thinking about our members' interests, and we wouldn't want to be doing less just because we're not a profit-based scheme.
I think, Sarah, on that note, I mean, that's just pitch perfect. Thank you. That's so helpful. We'll move on to David, if we can, the guidance on financial product advertising. This is analogous, really. Last month, FMA released guidance on what good conduct in the advertising of offers should look like, pursuant to the FMCA fair dealing provisions, which prohibit misleading or deceptive conduct, false or misleading representations, and making unsubstantiated claims. An advertisement's any form of communication made for the purpose of promoting an offer. So relevantly here, it can include, say, a brochure, a fact sheet, direct mail, group presentation or newsletter, or even smoko room poster, if going out to any potential new members. And of course, a number of you are still on offer to new joiners. FMA comment that the central consideration for determining whether an investment breaches the FMCA will be the overall impression it creates. And this is when viewed through the lens of an ordinary and reasonable reader, someone neither unusually astute nor unusually gullible. Representations true and verifiable in isolation can still generate a confusing or misleading impression when viewed holistically. And omissions can mislead too if they create an overall misleading impression. And the guidance sets out FMA's general expectations for advertisements. And these include substantiating claims, i.e. ensuring that there's a reasonable basis for a representation when it's made. Anecdote, unsupported opinions and assumptions don't suffice. And one such area to watch is asserting that a scheme is low cost, for example. Secondly, being truthful and accurate, which includes ensuring all information is current, complete and accurate throughout the life of the advertisement, and presenting it in a way that's readily understood and gives prominence to key information. Next, ensuring that any comparisons are only made between sufficiently similar products and any differences are sufficiently explained. The need to be clear about risk and reward is another relevant factor. For example, not giving the impression that a scheme is safe or free from risk or returns are guaranteed. Here, care is needed even with some of the greyer assertions like relatively secure and highly liquid, lest they create a misleading overall impression. We need to avoid jargon, or if it's considered essential, explain it. And we need to present performance information in a balanced way and avoid cherry-picking data. And here it remains the case that past performance disclosures should include a prominent warning statement, that past performance isn't a reliable indicator of future performance. The reference period and the source of any comparative information should be clearly set out. And performance for periods of less than the recommended minimum time frame, which is set out in the PDS, shouldn't be advertised or promoted by itself. Instead, managers should disclose more than one performance period and note how performance may vary between timeframes. And I've seen a number of annual reports, for example, do a sterling job of this. And managers are encouraged to provide performance information for 1, 3, 5, and 10 years. So I'll turn over to Sarah and, of course, invite Gavin to put his hand up if he's got any comments.
This area does make me think of all the many hours I've spent doing marketing sign-offs at various points in my career. and some great war stories from that, but that's a little bit off piste, so I won't go there. I think again, this guidance just seems really sensible to me, but then I would say that as a lawyer probably. It's of fairly limited relevance to most of the schemes that I'm involved in, some being closed, one being compulsory, but it obviously does have some application to the information that we provide members, and particularly around the relative merits of different options for them, using the university scheme as an example. If they choose to join, if someone chooses to join the scheme, they have one of two options within the scheme that they can join, a locked-in section or the standard section, or they might choose to not join at all and stay with their existing KiwiSaver provider. And that can be quite a complicated range of options to step people through, and we continually try to be as clear as possible about how we present those to people in an accurate way. I almost laughed when you said not confusing, Mike, because this is such a confusing area for people. And in terms of jargon, when I was struck by how much there was when I first sort of joined this area. So I think for people, finding a way to keep that member perspective and that customer perspective of an average person who doesn't have familiarity with all this and how they would understand something is really key. And as a sort of non-finance person, I often try and act as that person in some of the schemes and say, well, if I had to read that 3 times to understand it, what hope does one of our members have? So I think that's an important thing to keep in mind. And obviously comparisons, because comparisons are really useful, but they are fraught with, I guess, risk if you get them wrong or they're in any way misleading.
Thanks, Sarah. And I've just going to the theme, we've had a bit of a running theme lately, a little bit of dialogue with FMA and MB about some of the finer points of detail of various bits and pieces of really good initiatives that just need a little bit of fine tuning. I've just had a commentator pop up say the problem with the guidance is it doesn't comply with its own guidance. The sample returns, for example, that are quoted on page 13 are incorrect. So this is a dialogue, and obviously if there are things that we think are not quite fit for purpose, we should be, we're part of a lead industry body, and we should be prepared to voice that. Gavin, have you got any comments on this space? Or
no, nothing else from me on that, Mike, and I'll let the guys know that put the guidance together that they might need to look at page 13. Good
stuff. I'll move on to conduct. So I'll just make a few brief observations. David, next slide. So FMA's Guide to Good Conduct has now been in place for 5 years, and it'll be updated in early 2022. It talks, as most of you will know, about what FMA call the 5 C's that are considered the building blocks of good conduct: capability, communication, control, culture, and conflict management. And Sarah will talk shortly about how her client schemes have picked up on and reflect those building blocks in their everyday governance. The guide's now being complemented by the Conduct of Financial Institutions, or COFI, legislation, which is expected to pass by mid-2022 and be fully enforced by December 2024. In key overview terms, COFI, which in this space will apply only to licensed managers and therefore won't explicitly impact restricted schemes, will firstly require financial institutions to create and comply with their own fair conduct programs designed to ensure they treat customers fairly, and secondly, publish summary information about those fair conduct programs. And overarching all of that stuff is the imposition of what the Ledge calls a fair conduct principle, which requires financial institutions to consider a range of factors when designing their programs. And those include paying due regard to customers' interests, acting ethically, transparently, and in good faith, assisting consumers to make informed decisions, the sort of things Sarah was alluding to earlier, and ensuring that services and products are likely to meet consumers' requirements and objectives. So again, Sarah, any comments?
Thank you. This is another area where the guidance has been a really useful tool for self-review in some of the schemes that I'm involved in. I mean, it's tempting to think, well, we're not for profit, so a lot of this doesn't really apply. We're fine. We don't need to worry too much about the stuff we're doing it. But I think it's a really useful exercise to go through those quite detailed points and ask yourself, how can we show that we understand our members' financial sophistication? How can we show that the funds we're offering or the products are suitable for their purposes and meeting their needs? And actually looking at it in that sense drove some really interesting discussion and came up with some really interesting action points. One of the other challenges is that, at least as Mike's already mentioned, most of the schemes that I work with, they're largely outsourced. So when you're thinking about things, sort of questions or posing questions around values and culture and behaviour of employees, it actually prompted some really interesting discussion and reflection on how that works when the people who are interacting with your members are outsourced providers, and what does culture look like in that context, and how do you sort of factor in that setup to some of the questions and thoughts that you should be thinking about in this area. And I think one of the good things that it maybe prompted us to look at was how we could take what further steps we could take to make sure the people who were dealing with our members understood them as well as they could and understood their needs or particular circumstances. So we've sort of enhanced the information we provide, information flows to people who are dealing with our members, and try to share as much of that picture as we can, but also trying to capture information back from them. We get some pretty good reporting, but making sure we know what conversations our members are having, not in a privacy invading way, of course, but what topics they might be contacting about, concerns, visibility of any complaints and how they're dealt with. So that's been one area of focus that's come out of it. And I suppose the perennial challenge of member engagement, how we understand what the priorities of our members and our particular needs. And I know it's a real challenge for KiwiSaver schemes as well, trying to engage members. Luckily, I guess on the schemes that I'm involved with, you actually do have people on the board representing members and their interests, which is really helpful. And I think another thing I took out of the conduct guidance is making sure we make the most of those perspectives and get as much as we can from the people who are there and know in detail about our members. And it can be as simple as how you communicate in a way that people who are on shift work or who won't necessarily be able to get to a phone in business hours, that is accessible for them. Those sorts of considerations.
Thanks, Sarah. And I must say, for a relatively small and of course closed scheme, the New Zealand Post plan is a really first-class exemplar of really thinking about how best to communicate to a particular cohort. Really commend that website, for example. It's just the design is just first class. Gavin, did you have?
Oh, sorry, I was going to say one other example of the different ways in which you can engage with members. So the New Zealand Post directors went on a roadshow a year or so ago and actually travelled around the country and met with members at different sites to make themselves available, because that's what works for that membership base. Whereas perhaps with the university scheme, you're more likely to get engagement by setting up a seminar with a learned speaker like Mary Holmes. So it's about trying to tailor your approach to what you think or what experience tells you works.
Yep. Gavin, did you have anything?
Yeah, thanks, Mike. Yeah, I had the opportunity pre-COVID to attend a full-day trustee board meeting for one of the restricted schemes, and I was very impressed with the the level of interaction by all of the trustees on the matters that were on the table on the day, and certainly I think that there is a lot of passion around the board tables of the large restricted schemes, and to ensure that the best outcomes are achieved for members, and that I wholeheartedly support the comments that Sarah made in terms of what trustees should be thinking about, and just testing themselves against the principles that are in that wagon wheel.
Thanks, Gavin. Well, we were, or I wanted us to be, which is actually to leave Sarah with a good 10 minutes to talk to us about the issue of our time, which is, David, climate change. And we're talking here about duties and disclosure requirements. In October 2019, Chapman Tripp, commissioned by the Aotearoa Circle, published an opinion concluding that in order to discharge their legal obligations under FMCA, trust legislation and common law, scheme managers, when making investment decisions and or designing investment policies, are firstly permitted to take climate change risk into account, if to do otherwise would pose a financial risk to the investment portfolio, and secondly required to take climate change risk into account where to do otherwise could pose a material financial risk to the particular portfolio. We said a scheme manager needs to identify and consider all material financial risks in order to be acting in the member's best interest and in furtherance of the proper purpose of the scheme and its duty of prudence. Now, where the financial risk presented by climate change is assessed as significant, managers are expected to design an investment policy which appropriately accounts for that risk. The Cowan and Scargill case for the lawyers among us from 1985 remains important in this context, because it confirms that fiduciaries managing others' money are not at liberty just to indulge their own moral scruples. But it shouldn't be misread as asserting any duty to maximise profit at all costs by focusing on short-term, non-risk adjusted gain at the expense of longer-term financial considerations. Retirement schemes are long-term by their nature, and trustees must, in our view, take into account all material financial risks over that investment period. And if that means weighting a portfolio against, or even if the data justifies it, avoiding certain immediately attractive but carbon intensive investments to promote longer term stability and performance, then in our view that will satisfy the best interests duty. Now, there's now some pretty tough stuff emerging in this area. We saw it last week. It's coming thick and fast. It's bearing out the conclusion in the 2015 publication Fiduciary Duty in the 21st Century, which concludes that failing to consider long-term investment value drivers, which include environmental, social and governance issues in investment practice, is a failure of fiduciary duty. So trustees shouldn't shy away from thinking through indirect downstream financial consequences of investment decisions for fear they're somehow prohibited from considering ESG factors. And this issue is only going to keep growing in prominence. In the UK, a new Pension Schemes Act 2021 requires trustees to assess, manage and monitor the impact of climate-related risks on their scheme on an ongoing basis and publish annual reports online. Recently, the EU adopted a directive requiring pension providers to conduct risk assessments, including as to climate risk, every 3 years or after any significant change in the pension fund's risk profile. And a 2021 Australian legal opinion concludes that in order to act prudently and in the beneficiary's best financial interests, Australian superannuation trustees must ensure that their processes, structures, and expertise are responsive to the financial risk posed by climate change. And a major pension scheme was sued in a high-profile claim in Australia last year for failure to disclose climate risk to its long-term investments. And alongside all of that, New Zealand is passing legislation requiring all listed companies, large insurers, banks, and retail scheme managers with $1 billion or more under management to publicly disclose the risk that climate change poses to their businesses. The Climate-Related Disclosures, or CRD, Amendment Act became law just a fortnight ago, and it inserts a new climate change reporting framework into the FMCA, with affected entities required to provide and publicise audited annual climate risk statements from late 23, early 2024. Restricted schemes, however large, are explicitly exempted. But this is very much an area where the law will set a new benchmark and deliver important real-life learnings for trustees. Lastly, we even have a Companies Directors' Duties Amendment Bill, which would clarify that a director may take into account recognised ESG factors in determining the company's best interests. So we look forward to hearing from Sarah on this topic.
Thanks, Mike. I mean, it is truly the issue of our time, climate change. I find it quite fascinating how this has evolved over the time that I've been a trustee, from the more traditional view that you outlined, which was that maximising returns it was everything and you shouldn't look to do anything else, to a gradual realisation that actually ESG factors, particularly I think initially governance, looking to that actually was an indicator that you're likely to enhance your returns, so that it wasn't you weren't swapping out returns for ESG considerations. And then the thinking has really evolved in recent years around the need to actively be turning your mind to these risks and how they affect your portfolio, or you might not even be discharging your duties as a director. And it's been great, some of the thought leadership in this area from people like Aotearoa Circle, which of course involved Chapman Tripp with the opinion you mentioned, and also the New Zealand Super Fund has shown real leadership in this area. And I've attended some really great events that they've put on in conjunction with Otago University, sort of sharing research and experience in this area. It's really, on the ground though, it's been really tricky, and thinking about the different schemes I'm involved in, I reflected on the extent to which membership engagement may influence the prominence of this issue for the board. Unsurprisingly, it's probably one of the most common things that we get contacted by members about in the university scheme. And it's always been very clear to us that our members have expectations in this area. In comparison, other schemes, maybe the members engage less, but when you dig down into why that's the case, and focus groups and things like that, the assumption is that you're doing it, you're addressing it. And I think that I have a view, don't know how accurate it is, but the nature of these schemes, members have a sense of, maybe more of a sense of ownership of the scheme and enhanced kind of views that it will do the right thing, or things that are consistent with their what they expect in terms of some of these positions. I really welcome the new reporting framework, because one of the difficult things is having a sort of standard approach. No sooner do you try and look at how you can address climate change issues in your portfolio, as you can get bombarded with a lot of conflicting information, and one approach will then get criticised by someone else, and there'll be reasons why it works or it doesn't work. And then is looking at having consistent and accurate information that you can base decisions on. And to that extent, I think having a uniform reporting framework is going to be hugely useful. In grappling with what this means for the schemes that I've involved, this has been on understanding what the exposure is for the schemes, having information about what our carbon intensity is, how that compares to benchmarks, how it might compare to other schemes. For a while now, we've been looking at looking at the ratings of managers and what they're rated at from an ESG perspective, and that will give us some idea of the extent to which they incorporate those considerations into the investment choices they're making and their interactions with various companies. And I think that's quite an interesting area in terms of how you can actively engage, how managers can actively engage with companies to influence their choices and the role that they might play in the transition. One choice that we were considering in a couple of schemes is whether to launch a specific socially responsible product, and whether that was the way to make sure that members had an option open to them around socially responsible investing. But so far the focus on particularly the two largest schemes I'm involved with has been looking at the issue across the entire portfolio rather than making it something that sits out to the side and that people can invest in specifically. So that's sort of how we've been thinking about this. It really seems to be picking up pace, which I find exciting and hopeful, but it's certainly complex and not an easy area at all.
Yeah, it's gathering momentum. Thank you so much, Sarah. Gavin, I want to give you the last word. No, we've paced ourselves perfectly. I really want to thank both Gavin and Sarah for those insights. Obviously, we're an FSC hat, but just invaluable IQ. So thank you both so much. We're barreling towards 10:30. Before I close, I just want to mention that due to COVID-19 restrictions, the conference on the 6th and 7th of December will be online. And I also want to mention the upcoming sessions just before we close. So last slide, David, before we log off. There's some great sessions, some great content still coming, including just next Tuesday, conversation with Graham Dyer on health insurance, and sort of bi-weekly, really first-class webinars between now and when we then in the end of the first week of December convene the main conference forum. So thank you all so much for attending. That was really, really good engagement and good dialogue, I hope, and hopefully good learnings for each of you that have stuck with us for this hour on things that, while they don't directly sit on a compliance manual or bind or impact upon schemes on paper, nevertheless give us really useful learnings. A couple of chat points. No, just thanks from attendees, so that's just fantastic. Thanks everybody, have a great day. Cheers.
Thank you.
Ka kite anō.